how will the Interim Budget 2024 impact your personal tax? Let's dive in to understand the implications. As we know, the budget session of Parliament began on Wednesday and will be the last session of the present Lok Sabha. With general elections likely to take place in April-May this year, the budget holds particular significance. Our Finance Minister, Nirmala Sitharaman, is set to present the interim budget on February 1st, marking her 6th consecutive year in this role. And all eyes are on the potential changes that could significantly impact personal taxes. In this video, we will delve into the nitty-gritty of the Interim Budget 2024, focusing on 4 key tax-related topics. Each of these could influence your personal tax in different ways. First, we will explore the basic exemption limit. Rumors have it that the budget might raise this limit by at least 50,000 rupees under both the existing regimes. This increase could potentially reduce the tax liability for all taxpayers. Next, we will discuss the National Pension Scheme. As it stands, an employee can deduct their entire contribution to a notified pension scheme from their taxable income. But this deduction cannot exceed 14% of the salary for central or state government employees and 10% for other employees. The upcoming budget might address this disparity. Then, we will touch upon the standard deduction. Currently, salaried taxpayers can claim a standard deduction of 50,000 rupees. Speculation suggests that the budget might consider increasing this deduction to 1 lakh rupees. Lastly, we will talk about tax deducted at source or TDS for home buyers where the seller is a non-resident Indian. The current provision requires a 1% deposit of the purchase value as TDS if the property value is 50 lakhs or more. We anticipate a simpler TDS process in this budget, so buckle up and get ready for a deep dive into the world of personal taxes and the possible changes that the Interim Budget 2024 could bring. With that overview, now it's time to delve into the specifics of how this budget could affect your personal tax. First up, we have potential changes to the basic exemption limit. Now, for those who might not be familiar, the basic exemption limit is the threshold income above which one is required to pay tax. In other words, it's the income level below which you're not taxed. It's an important aspect of the tax structure, as it determines how much of your income is shielded from tax, and consequently, it influences your overall tax liability. Now let's talk about the possible changes. The buzz around the corridors of power suggests that the Interim Budget 2024 could likely raise the basic exemption limit by at least 50,000 rupees under both the regimes. That's right, a potential increase of 50,000 rupees. Now you might wonder, what does this mean for taxpayers? Well, an increase in the basic exemption limit essentially means that a larger portion of your income could be exempted from tax. This in turn would lower the taxable income and consequently reduce the tax liability across all taxpayers. To put it in simpler terms, if the basic exemption limit is raised, it means that you get to keep more of your hard-earned money, as less of it would be subject to tax. Whether you're a salaried employee, a business owner, or a freelancer, an increase in the basic exemption limit could potentially benefit everyone across the board. It's important to remember that these are predictions based on current trends and speculations. The actual changes, if any, will be confirmed when Finance Minister Nirmala Sitharaman presents the interim budget on February 1st. So, keep an eye out for the budget announcement. It might just bring some good news for your wallet. After all, who doesn't like the idea of more money staying in their pocket? So, an increase in the basic exemption limit could mean more money in your pocket. Next, let's look at potential alterations to the National Pension Scheme. The National Pension Scheme, or NPS, has been a cornerstone of retirement planning for many. As it stands today, if you're an employee contributing to a notified pension scheme, you're allowed a deduction of the entire contribution you've made during the financial year. However, there's a catch. This deduction cannot exceed 14% of your salary if you're a central or state government employee. If you're employed elsewhere, this limit drops down to 10% of your salary. This disparity between the two brackets has been a point of contention for some time. It raises questions about the equitable distribution of financial relief and benefits among different sectors of employment. While government employees enjoy a slightly higher limit, those in other sectors find their deduction capped at a lower percentage. Now, we're looking at the possibility of the government addressing this issue in the interim budget of 2024. The word on the street is that there could be an end to this disparity. If this change comes to pass, it could mean a more uniform approach to pension scheme deductions. Irrespective of where you're employed, the deduction limit on your pension scheme contribution could be the same. This proposed alteration holds significant implications. For starters, it could level the playing field for all contributors to the national pension scheme. More importantly, it could potentially increase the amount of income that can be deducted from tax, thereby reducing the overall tax liability for those in the non-government sector. But as with any budgetary proposal, it's all speculation until the Finance Minister, Nirmala Sitharaman, presents the interim budget. As the day draws near, all eyes are on the Parliament, waiting to see how these potential alterations to the national pension scheme will unfold. A change in this area could signify a more uniform approach to pension scheme deductions. So let's watch and wait, as the budgetary decisions of today will shape our financial landscapes of tomorrow. Another critical area of focus is the standard deduction. Now, for those who might be hearing this term for the first time, let's break it down. A standard deduction is a flat amount that the tax system allows you to deduct from your income before calculating your tax liability. In the Indian tax system, salaried taxpayers are currently permitted a standard deduction of 50,000 rupees. Now, why is this important, you might ask? Well, the higher the standard deduction, the lower your taxable income, and a lower taxable income means a lower tax bill. So, a standard deduction is essentially a tool to reduce your tax liability. Now coming to the Interim Budget 2024, there's some potential good news for salaried taxpayers. The budget could consider increasing the standard deduction, and it's not just a minor increase we're speaking about. The standard deduction for salaried employees could potentially be doubled from 50,000 rupees to a whopping 1 lakh rupees. Just imagine the kind of impact this could have on your tax liability. A higher standard deduction means you can subtract a larger amount from your gross income before you calculate your tax. This essentially translates to a lower taxable income and therefore a lower tax bill. However, it's important to remember that this is still a possibility. The final decision rests in the hands of the Finance Minister. But if this change does come into effect, it could mean a significant increase in deductions for salaried individuals. It's definitely something to keep an eye on as the budget unfolds. So, if you're a salaried individual, keep your fingers crossed. This potential change in the standard deduction could be a game changer, making your tax planning much easier and potentially reducing your tax liability significantly. This potential change could mean a significant increase in deductions for salaried individuals. Lastly, we have potential changes to tax deducted at source or TDS for home buyers where the seller is a non-resident Indian. The current process for depositing TDS in case of a resident home seller with the government is a bit complicated. As it stands, if a property is valued at 50 lakh rupees or more, 1% of the purchase value needs to be deposited as TDS. This is a considerable amount and can sometimes be a stumbling block for home buyers. What's more, the process of TDS deposit is not straightforward. The buyer has to obtain a tax deduction account number or TAN and then deposit the TDS to the government. They also have to furnish a TDS certificate to the seller. This involves a lot of paperwork and can be quite time-consuming. But here's the good news. The Interim Budget 2024 might just bring about a simpler TDS process. Yes, you heard it right. The government understands the difficulties faced by home buyers and is considering introducing changes that could simplify this process. While the specifics of these changes are yet to be announced, it is expected that the process could become more streamlined, with less paperwork and perhaps even a lower TDS rate. This could be a game changer for home buyers, particularly those buying from non-resident Indians. It would make the process of buying a home less daunting and more accessible. Of course, we will have to wait until the budget is officially unveiled to know exactly what these changes are, but the possibility of a simpler TDS process is certainly something to look forward to. It's yet another way in which the Interim Budget 2024 could impact your personal tax and make life a little easier for you. So, keep your fingers crossed and stay tuned for more updates on the Interim Budget 2024. A simpler TDS process could make property transactions a lot easier for homebuyers. So, that's a quick look at how the Interim Budget 2024 could impact your personal tax. We've delved into the potential changes to the basic exemption limit, which could see an increase by at least 50,000 rupees under both regimes, reducing the tax liability across all taxpayers. We also touched on the National Pension Scheme, where we might see an end to the disparity between the two brackets of contributions. We discussed the possibility of an increase in the standard deduction for salaried employees from 50,000 to 1 lakh rupees. Additionally, we explored the chance of a simpler TDS process for homebuyers where the seller is a non-resident Indian. Of course, these are all predictions based on the current economic climate and past trends. Remember, these are just predictions. The actual impact will be known only once the budget is officially announced. Stay tuned for more updates and thank you for watching.